In the next 10 minutes or so, I'm going to try and do the impossible and place this conflict in the Middle East or in Iran into some type of perspective despite the changing headlines and Twitter cycles every 2 to 3 minutes. Now, I've written many times in the past that as hegemonies reach a financial or political inflection point, we historically see what I call the 4 Ds. The first D is debt, the second D is debasement, the third D is dishonesty, and the fourth D is desperation. Now, certainly we know at 39 trillion, the US is in a massive public debt kind of trap right now. In terms of debasement, what we've seen with the DXY and the expansion of the M2 money supply, the dollar hasn't exactly been ripping even despite higher rates and clear safe haven trade during this conflict. Dishonesty is something we've been tracking for years, whether it was the definition of inflation or the definition of a recession or transitory inflation, etc. So we know dishonesty is a part of policy in empires or nations or systems that are breaking down. And of course, desperation, as we've talked about with the Ernest Hemingway quotes and other videos, is nothing new to failing regimes. In the US, these desperate attempts with Doge or US aid or Liberation Day tariffs or the stablecoin measures of more centralization are all other forms of desperation. But as our prior interviews or discussions on Ernest Hemingway's example said, the biggest sign of desperation is currency debasement and war. And all of this is culminating right now in Iran. This is a pattern that was not totally unforeseeable. In a public event in Amsterdam in February, I said regime change in Iran was inevitable. This is because oil is very critical. It's a critical pillar to the US dollar. And if you don't want to believe me, you could ask Muammar Gaddafi, Saddam Hussein, or the Ayatollah Khomeini, but they're not here anymore to ask. Nicolas Maduro still is, but he was whisked away in a helicopter. My point only is that the oil and dollar relationship is a serious relationship. In fact, it's a deadly serious relationship. Now, what we see in Iran, to me, this is a dollar war. It is a US Treasury war, and it is an oil war. It's not really an Iran war. Whether we like it or not, we live in an energy-centric, not dollar-centric world. But if the dollar, having welched on its gold backing, loses its oil backing or its petrodollar status, then it's game over for the dollar. And of course, that's worth fighting for. Now, we know that Trump 2.0 and his campaign platform was all about America first, about avoiding useless, expensive wars, whether that was in the Ukraine or other parts of the world. In a lot of ways, Trump was kind of reflecting what George Washington, America's first president, had said. And Washington said that truly enlightened and independent patriots focus on prosperity within their borders, not peripheral wars outside of them. Of course, that was the platform that Trump ran on. That's not where we find ourselves today. But we also have to be realistic. The famous Prussian general Karl von Clausewitz, the Prussian officer, famously said that war is just an extension of politics by another mean. We also know that politics is an extension of economics. And this is a war about the dollar and the US Treasury, not just Iranian ideology. It's a kind of a triangle of the gold, oil, and dollar. Now, for US dollar hegemony, or US hegemony, because they're very much linked, this is on the line right now. The US has reached what some would call a fourth turning, what I've written or described elsewhere as a Gettysburg moment or a Waterloo moment. Again, in the examples of Gettysburg or Waterloo, didn't mean the end of the South or the end of France, but it did mean the end of the Army of Northern Virginia, the Confederacy, or the Grand Army, or Napoleon's France. So it's not the end of the world, it's just a change, and we're at that inflection point now. Our debt is too high to grow out of. We could face a potential strategic military or economic defeat. Are we winning? I don't know. I know in our country, in the United States, we lost 55,000 American servicemen during the Vietnam War, over 1.3 million Cambodian, Laotian, and North Vietnamese died, and we didn't necessarily win that war. I'm not predicting what's going to happen politically here or militarily. I'm not an expert on that at all. It's just going to be a very difficult matter depending on where peace, ceasefires, or further war goes. No one really knows. What I can talk to is the economics of this war, the parties of this war. They all have very different interests, and it's a very tenuous relationship. The US, of course, wants to save the petrodollar, the US dollar, the US Treasury, and hence the hegemony. because for every petrodollar bought, the producers of that oil have to buy US Treasuries, and that absorption of buying US dollar-based oil helps minimize inflation risk for the US dollar. It's a big sponge for that dollar. It's therefore no coincidence, again, that countries like Iraq, Libya, and Iran and their leaders have lost their lives trying to get outside of this petrodollar. Then again, Venezuela's leader got a helicopter rather than a bullet. But this is, again, a very deadly, serious game. The world is oil-centric. America has oil too, but it doesn't want to see that oil sold outside of the dollar. Now, China is another party to this war, even though it's not directly involved in the military conflict. For many years, it's been seeking a non-dollar oil solution or a non-dollar energy solution. Not necessarily a slow drip toward a petro-yuan, but what it does want is a weaker petrodollar to dethrone the dollar. Now, 95% of Iran's oil went to China. And before Maduro was whisked away in a helicopter, it was only 5% coming out of Venezuela. But Maduro was in talks to sell more oil to China right before he was whisked away. As for Iran, some would say that Trump is playing 3D chess. Again, I'm not here to give a political opinion or a military diagnosis. But the first rule of chess, or the first tenet of chess, is always assume your opponent has a better move. Iran has certain moves here that don't require military victory. Iran wants to endure long enough to use the Strait of Hormuz as a lever to break Western US financial system and to discredit Trump. Again, Iran doesn't need to win, just endure. It sees the logistics. It sees that Trump planned on a short war. They have called it now a slaughterhouse. Their strategy is to crash the global economy and see the NASDAQ go no bid or the bond market go no bid and force America to use QE to the moon to base its currency and lose its dollar hegemony. In the backdrop of all this, of course, is Russia. It wishes to expand its influence. It has plenty of oil too. It has natural resources. It has weapons. It can sit back and secretly or quietly provide radars or other missile services to Iran without being directly involved in the war. And finally, there's the GCC, or the OPEC nations. The GCC includes Bahrain, Kuwait, Oman, the UAE, Saudi Arabia. All they want to do is sell oil and get revenue and use that revenue to buy gold. They're very much on the fence between the East and West systems. Now, we all remember Saudi Arabia's premier having a famous handshake with Xi in China and a fist pump with Biden in America. There's a tenuous relationship between Saudi Arabia and the US. And Saudi Arabia knows that the petrodollar was effectively forced upon it at knife point. This war right now is disrupting the income flows for the GCC nations, or the OPEC countries. It's not only disrupting their income flows, it's increasing their military expenses. So Saudi Arabia recently was forced to sell about 50 tons of its gold to raise needed reserves to pay for its import of food and other things. And they've been on the fence since 2022. Saudi Arabia has been importing massive amounts of gold from Switzerland. And they use that gold to buy Chinese imports, which have increased also massively since 2022. So this tenuous relationship between the OPEC nations in general, Saudi Arabia in particular, and the US, and this move very slowly towards China buying gold and buying Chinese imports are all interesting signs of massive changes happening in the Middle East. In short, gold is involved here. Even gold was the US biggest export until this war began. Even the US was beginning to net settle in gold. So the other big party to this conflict is the world itself. Global supply chains impact the cost of everything, not just food and gas. And this global supply chain and this global market is far more fragile than we think. In 2008, for example, during the Great Financial Crisis, that was triggered by just a 5% default of all mortgages in the US. People thought of this as great US mortgage crisis. It was only 5% of those mortgages, which is very fragile. If we also see private credit implosion, it's about the same value of the subprime mortgages in 2008. It's a longer conversation, but there's a very high risk of private credit leading to a similar implosion. So it's a very fragile system. If we get to 6% unemployment, that too could create a massive recession and therefore a market sell-off. Or if US bond yields just go above 5%, we could see a massive recession and a massive sell-off in the markets. So it's a very fragile system. In the meantime, in the rest of the world, Europe is getting weaker. Australia is running out of diesel. Other oil dependent nations like India get 50% of their oil from the Gulf, Turkey over 90%, Japan 75%, and South Korea 70%. Then you throw in Southeast Asia, Taiwan, very low on LNG, so they're fuel rationing. The markets had assumed a peaceful solution, but we don't know if that's coming yet, and we don't know how long this ceasefire is going to last or whether it'll be effective at all. What I'm saying is it's a very fragile world in the backdrop of this conflict. But in the meantime, we also have 5 major economic risk signals that I want to share with you today to put all this in perspective. The bond market, as I've said many times, is everything. And with rates and bond yields rising, this is dangerous. Earlier in the year, JP Morgan, Goldman Sachs, and others were predicting low rates and a soft landing for 2026, but that was before the war. Also before the war, interest expense on Social Security, Medicaid, and U.S. Treasury obligations was 20% higher than tax receipts. Again, this was before the war. We have to also keep in mind that the U.S. is now looking at a $1.5 trillion military budget. We simply don't have the income or the tax receipts or the GDP to pay for these expenses, so we're going to add it to the U.S. bar tab. Now, countries in the European Union or countries like the UK, which hold 40% of U.S. treasuries, are also suffering, and they're going to have to start dumping some of those U.S. treasuries to get liquidity. When they dump U.S. treasuries, there's a sell-off that pushes yields and interest rates higher, which America simply can't afford right now at this debt levels. In the meantime, this fancy thing called the U.S. net international investment position, which basically just means how many assets the U.S. holds outside of the U.S., is actually negative 80%. It means we don't have a piggy bank. And in a time of crisis, other countries outside of the U.S. that hold our assets, our treasuries, our stocks, who are looking for liquidity, could be forced to make a sell-off in those assets. That would put massive pressure on the U.S. markets and the U.S. Economy. So there's a lot of risk in the bond market. Meanwhile, in the stock market, it's very complacent. It's like a twilight zone. It was pricing in a quick war. But at debt levels this big, something has to break. And in my opinion, it will be the markets. And probably most likely it'll come from the private sector and private credit. Even Jamie Dimon is very worried about private credit being the next 208 trigger. Now we're seeing rising rates and rising debt and tanking stocks. That's what will happen if we get to a point where interest rates go above a certain threshold. For me, it's about 5%. The private credit implosion is very real. And the AI hype that that's going to save us, to me, is another longer conversation, but it's a very dystopian solution, in my opinion, and very, I think, naive. Finally, what we're seeing right now is widening credit spreads, and these always precede bear markets. The bond and the jobs market are pricing in pain. And speaking of that jobs market, Bureau of Labor Statistics just came out, non-farm payrolls just came out. We're losing thousands of jobs as of now. But if you look back to 2025, not only did we not create new jobs, the year of 2025 saw a net destruction in jobs. In addition to that labor signal, or that labor pain, we have a national debt that is now grossly outpacing income. Even Jerome Powell, no friend of Trump, of course, right now, is being forced to openly admit this. Our debt is simply outpacing our income at a dangerous level. And finally, of course, there's just the dishonesty, that one of the D's I talked about, the 4 D's above. We've seen so much dishonesty, there's so much distrust, whether it was transitory inflation or the non-recession that was a recession and is a recession, the Doge, USAID, Liberation Day, even things as what's the status of the Fifth Fleet in Bahrain, or strategic radars destroyed, or attack helicopters, or the real status of Tel Aviv. We really don't know. In the media, we're getting crickets. We know Russia's providing intel satellites and missiles. We don't know. We also know there was market volatility where the futures, over 1.5 billion in futures contracts kind of were traded just before Trump announced a peace negotiation. Someone made 60 million in 20 minutes. That looked like an insider deal. Again, not trying to get political. Something's going wrong there. There's something dishonest in our system. Trust is failing. So as we try and put all this into perspective, it looks very fragile. And there's pretty much 3 outcomes here that we'll conclude on. The first outcome, which would obviously be the best, is the war just ends. A great big kumbaya, peace, love, and happiness moment. Strait of Hormuz opens, and we're back to normal. Possibility. But even in such a case, a lot of the damage has been done. The inflation would only be delayed, but it's still going to be coming. The petro yuan wouldn't replace the petrodollar, but the rise of the yuan would rise in the oil trade market, and the dollar will weaken. In a second scenario, the war continues. And in that scenario, things break irreversibly. In the UK, in the European Union, the bond markets would crack first. They would sell off US Treasuries, and then the US bond market would break. When the US bond market breaks, interest rates go to the moon, yield curve control is set in, QE spikes. And really that's not the end of America, but it would be a massive recessionary force, a massive downward pressure on the markets. And it's the same scenario if the war drags out even further. Again, yields will spike, emergency measures will kick in like QE or yield curve control. We might even see a soft default, what I call a soft default on the US Treasury. Besant has talked about that. He would just extend the duration of the Treasury bonds and then cut the coupon from, say, 3% to 1%. Technically, that's illegal, but as an emergency measure, it would probably be allowed. Either way, we're going to see printing of more money and the expansion of the M2 money supply into an oil spike and inflation to the moon. In such a backdrop, no matter how you look at it, best case to worst case scenario, money supply expansion, emergency liquidity measures are coming, and gold will get its last laugh and final say as a far more honest form of currency protection, historical risk protection, market risk protection, and frankly, geopolitical risk protection. So if you're taking the longer term view on gold, you don't have to be patient. You just have to understand math and history. So I hope this puts some of this in perspective. Thank you.